Okay, so we may be a touch early, it's hard to say, but I think I'll just say welcome to anyone that has joined us for the NBRA Finance Surgery drop-in webinar. Thank you ever so much for sort of joining us today. So, oh, I've completely lost my screen, that's great, there you go. So why have we done this? So obviously, you know, 2021 has been a particularly difficult time for repairers. I think it's thrown a lot of unique challenges to our industry that we've never really seen before. Without question, it's put all sorts of pressures on body shop finances and has required them to sort of look into spaces that they're probably not so au fait with. We all recall the worst times of COVID when claims were up to 80% down on what the norm was. And of course, you still had to endure all of your fixed costs, even though, fortunately, the government stepped in with the furlough scheme and was able to support you to some degree. It must have been extremely difficult times for body shops. So consequently, it's fully understandable if businesses are now surviving on depleted cash reserves, trying to restart their businesses and reinvest on the back of a really difficult period. There may well be body shops that have just started working with accident management companies again and are having to sort of fund that process of repairing, paying for the paint, paying for the people, paying for the parts, knowing that they're not going to get any kind of repayment back inside of 30, 60, 90 days. You know, just starting that whole wheel of reinvesting in your business again. Other businesses may have felt that this whole period was so difficult, they might be considering exiting the industry. You know, giving some consideration to, do I really want to continue doing this? You know, might I want to sell my business? Others are seeing it as an opportunity to grow, to pick up businesses that people want to leave. They see the future as an opportunity and might be interested in growing the business and reinvesting. All sorts of things that are real sort of challenges for body shops. Of course, we've got the whole green revolution coming at us as well. The requirement for sort of PAS 2060 to start reducing your carbon footprint, that might well require a lot of investment. And we've got the huge challenge of electric vehicles. So the road to sort of 2030, and the fact that body shops are going to have to invest right now to be prepared for the very first electric vehicles that come through their door, both in terms of staff training, equipment, and everything else. So investment in training, maybe looking at refinancing, you know, difficulty in putting business plans together, or you know, getting your books together to look in the right space. So there's lots of questions and lots of challenges that are heading in the body shop direction at the moment. So recognising all those challenges, the NBRA thought they would get a collection of experts together, not in every single field of body shop finance, but in a collection of spaces, to see what they can offer and to see what questions you may have, and see if there's any ways that we can help. So I'm going to say sort of quick hellos around the table. If you are on the call, you might see that there's a questions tab or a question and answer tab that you can find. If there's any questions that you want to pose to the panel or myself, just hit the questions tab, or you can make comments, and at some point we'll be able to pick those up and feed them back to the panel. Okay, so just sort of going quickly around the room for hellos. We've got Chris Hurd here from HWCA. I don't know if you can give us a wave. Hi, Chris. Nice to see you.
Hi.
Thank you very much. We've also got Pete Bass from Accident Credit Group.
Hi, Chris.
Are you in the UK at the moment, or?
No, I'm not.
Yeah, amazing, isn't it? Well, you in Spain?
Yeah, I'm back tomorrow though.
It's a great reception. Don't worry about it. It's all looking good. We also have Marie Hibbert somewhere from Smart Business Link.
Hi.
Hi, Marie. How are you?
Good, thank you.
I see you've lost the fuzzy background. That's great.
Yeah. No more partying.
Super duper. No Gary today? Is he out and about?
He's out and about today, yes.
All right. Well, listen, thank you for joining us. Really appreciate it. We've also got Ray Jones. Can you give us a wave, Ray?
Good to be here.
Alex.
Nice to be here.
Nice to be. Thank you for joining us, Ray. It's super.
You're welcome.
So you.
Thanks for asking me.
You passed the test and managed to get our background in. Well done.
Yeah, I'll probably fall out.
Good job. Good job. And we also have Steve Bolt. Is Steve Bolt here?
Hi. Hi, Chris.
Hi, Steve. How are you?
I'm very well, thank you.
Thank you for joining us. Appreciate you coming along today, and hopefully you'll be able to help our members with a few things. And we also have Steve Johnson from TFS Finance. Are you there, Steve?
Hello, hello.
There you go. Super duper. Okay, so that's our panel. Does everyone want to check if they're so bring up the Q&A box just before we go. So we've got no open questions at the moment. I'll just close that down. Let's see if we've got any chat. And the chat is quite quiet as well at the moment. So let's see how we go as we get along. Okay, so just sort of opening this up. Probably start with Chris Hurd, if that's okay. Chris, you specialise in buyouts of businesses, putting together business plans, business forecasts for all kinds of businesses. Our members are often thinking about maybe either selling a business or growing. What kind of advice would you give them in that kind of space of being prepared?
In terms of selling, it's preparation is the key. So it's very difficult to, well, they won't maximise value if they decide to, if they decide to sell today and then press the button tomorrow.
Yeah.
There's lots of tax reliefs, there's lots of advantages, and it's very much a question of getting your ducks in a row. Planning is the key. I typically get involved with people 3 years before they decide to exit, and that way there's a whole plan that can be put together.
So if you wanted to get a good bit of value for your business, what is the way to sort of, because a lot of body shops have worked really, really hard over the years, and they've put a lot into their businesses, but at some point, I think a lot of them would like to realise that investment, and take some money out properly by selling the business. What's the best way to get a good value for your business?
The best way to maximise value is maximise your tax reliefs, like I've just said. Decouple yourself from the business. So if the business will run, if you're not there, that's within reason. Have a team that can run it if you're on holiday, if you're away, because one of the major things, the major leaks of value is a lot of the value is in the individual, in the entrepreneur, the owner. The more you can demonstrate that the value is intrinsically in the business rather than the individual, that helps to maximize the value, because ultimately the individual will want to exit, and the danger is that a buyer would look and go, well, as soon as they walk out of the door, so does part of the value. So that's a big thing.
How important is the profitability of a business when looking at selling it? So in terms of the net profits that the business make?
Typically, yeah, very important. Typically, a business is valued as a multiple of profit. So the higher the profit, the higher the value of the business. The multiple is also linked to the size of the business. So smaller businesses, lower multiple; more profitable businesses, higher multiple. In terms of value, you would then add on any surplus cash, less any debt, and that's fundamentally the value of the business. So maximising cash, reducing debt as much as you can in the build up to a sale, and then taking advantage of the appropriate reliefs. There's obviously entrepreneurs relief, as was the first million of any gain is 10%. So obviously and that's the best that people will do at the moment.
So I guess some some body shop owners will work very, very closely with their staff. They will have, mentored people within the business, and they would want to make sure that, the people that they leave behind when they leave have still got a big say in the business. How often do sort of management buyouts happen, and sort of how complicated is that? Could you give any advice in that respect if a body shop owner was keen to sort of have their staff buy out the business from them?
Yeah, I mean, it happens a lot. The beauty of a management buyout is you know who you're selling to. You have visibility. If you're selling to a third party, you don't know what you don't know. You know very little about them, really. Obviously, let's say someone's mentored someone from through the business, and they're intrinsically part of the business. Then it's often a very attractive route to take. Now, a management buyout's typically structured. The individual buying the business would often have to borrow money in their own right, but there are ways. If let's say they can't, let's say that it's a young chap and they're sort of fairly light in funds, then there are ways to structure it where the business borrows the money and leveraging the assets of the business, and the owner takes the money out that way, and the management buyout candidate doesn't have to borrow money. So there's lots of different ways of structuring it, but fundamentally it's agreeing a value that I've discussed with the multiple of the profit, and working out what can be put in by the individual. If there's nothing, then you're looking at leveraging the assets, things like assets of the business, the debtor book.
Okay.
Lots of money about, and doing it that way.
Okay, so if anyone, Chris, thank you ever so much for that. I know it's a very, very brief overview, but if any of our members were in the contemplating sort of selling their business, we could put them in contact with you and be able to give them some pretty good advice in that space about how to get ready for it. And as you say, you're probably better off starting that journey a couple of years before you actually, make that decision to go.
Certainly, I mean, in the case of, in the case of entrepreneurs relief, the enhanced capital gains tax structure, you have to have owned the shares in the business for 2 years. Okay. So you get the flavour. If you're a year away from a sale, you could move the shares across but you wouldn't necessarily qualify for that. If you start early, you can make sure you maximise your allowances and ultimately maximise your value.
Super, Chris, that's been amazing. We might well come back to you if we've got some questions.
Yeah.
But I think the big message I've taken from that is if you are considering selling your business, you need to give yourself a good couple of years of preparedness for it in order to get the right tax benefits and to get your business in the right condition to get the appropriate value for it. Yeah. Super. Thanks ever so much. Can I introduce Pete again? Pete Bass. Where are you? Are you back up on screen? There he is. There he is, on the way from Spain. So welcome, Pete. Thanks again for joining us. So ACG, or Accident Credit Group, are one of the largest repair invoice funders in the UK, I believe. Many of our members might already work with you. But if not, then could you give us a bit of an overview of how do repairers, or how could repairers really benefit from funding, especially if they have to give away a bit of a margin in order to do it? So how does that make sense?
Okay.
Simple question.
It's oddly enough, or unsurprisingly enough, it's a question that I'm often asked. And the short answer is that if it's used correctly, then invoice funding removes cash flow constraints around the business. And that enables the repairers, I suppose, ultimately to grow the business and increase their overall profitability. What we find is the key is for the repairer to understand how they want to operate. And let me explain what I mean by that. We've been funding repair invoices now for over 10 years. And whilst currently work with hundreds of body shops every month, essentially we have two different types of repairer client. And we've got those repairers that use us on a casual basis. And by that, I mean, they'll elect to send us, 5, 10, 20 invoices a month. And what they're doing by doing that is they're just improving their cash flow, but at the same time, keeping the overall costs of funding down to a manageable level. Then we've got those repairers who are contracted to us. And what they've effectively done is outsource their recoveries model to their operation. These operations historically might have used bank funding, or they might just have grown to a certain level and that they can see the cost of recovering money. And also, as you mentioned earlier on, the time it's taking to get the money in is a barrier to growing their business. So what they've done, they've basically outsourced it all to us. And that just reduces their overheads across the board, so they get savings there. But then also what we do with those guys is we just integrate systems as well. So we improve the efficiencies further, you know, in all areas. But
so it tends to work better if people just hand over everything.
I would say yes,
Yeah.
but they really need to embrace it, because, you know, if we're funding all their invoices, then yeah, they've got a cost on all those invoices. And if you just add that into a business, you might look at it and say, well, that strips the margin out. How does that make sense? So what they need to do is look at the benefits of doing that. And part of the benefit is they reduce their overall costs in relation to recovering invoices.
So this is like if you had a credit controller, you know, flat out all the time, trying to get money back for you, you could pretty much take that cost out of your business and then offset that against the additional bottom line that you might have to pay.
Exactly. It's that old adage that, you know, if someone can do it better, faster and cheaper than you can, outsource it. So when they look at that and look at all those costs that go with that, plus the benefit of having the money in their bank account in 24 hours, then they can, for example, if they know they've got the money in their account in 24 hours, effectively they're a cash buyer. So when it comes down to the fundamentals like parts, other things that might have credit lines on them associated to them, they can negotiate better deals.
Yeah,
we've seen that. So the size of the deal they can negotiate is down to them. Obviously, it depends on their volume, but they can do that. It also means they can be fleet of foot. If a particular parts provider they've got an account with can't give them what they need, they can just jump to another and get the parts that they need. But ultimately, it's about making that decision that whilst there's a cost to something, what's the benefit? Yeah. And we've seen it play out that, you know, casual users get the money straight away. What it means is that they're just correcting the cash flow position enough so the business can function. If they receive an opportunity to take work in from a work provider that perhaps the terms ain't so great because they've got to wait 60 or 90 days. Yeah. Well, now if they want to, they can get past that situation by working, you know, with someone like ourselves. Great. So for us, it's all about just improving cash flow. And then the other benefit that we always see with this is once you improve the cash flow in the business, it comes as no surprise to learn that the actual business owner can function better as an owner and leader, because they're focusing on doing the right things in the business for the right reasons, rather than juggling money and thinking, oh, how do I do this? How do I do the other? And that's something that's coming to the fore more than it used to, because as you mentioned earlier on, Chris, the lockdown, what it did was it kind of, it took away that pipeline of income that was coming in from body shops. Yeah. So now they're all starting to grow. It's like when you started your business again. Yeah,
exactly. Yeah, it's just that starting that wheel turning, and having to do all that investment without the money coming in. Have you seen an increase in, you know, body shops coming to you for support, or, you know, is it a marked increase, or is it static, or, you know, what's COVID done in terms of?
Yeah, what happened when it first kicked in? You know, we thought, right, people want to use it more. But of course, what happened was that businesses, they got all kinds of grants, business interruption loans, and so on and so forth. Plus, they had this pipeline of money coming in all the time, but they didn't have the same expenditure on parts and so on. So they were able to, operate in a better way from a cash flow point of view, not from an income, but from a cash flow point of view. So we found our business levels dropped quite dramatically. And what we've seen, each time we've had a little bit of recovery, our business levels start to go up. and then they come down again, and so on. So what we're seeing this time is the recovery is more sustained, and hopefully, fingers crossed, we're not going to go back to where we've been before in terms of lockdown and and I think what we're seeing is that more and more body shops have got confidence to go out there and capture the work. There seems to be less body shops. You'll know that better than us.
Yeah.
And so those guys are getting swamped with more and more work opportunity, and it just exacerbates the cash flow problem. So we're seeing our numbers of body shops that are working with us are growing, and the average number of cases that a body shop does with us is starting to grow as well. But interestingly, some of the guys that traditionally use bank funding, sort of confidential invoice discounting, and some of the members will be aware of how that works. The bank basically give you a fund and give you 70% of the repair invoice value, where, for example, 70%, when the repair is completed, you have to recover it as a body shop. So you've got all those costs, and then at the end, they'll give you a balancing payment, that's their fees. That's just not workable now.
What happens if you can't recover the money? So let's say you paid a repairer, £3,000 for a repair. You're trying to recover the money from an accident management company, and for whatever reason, you can't get hold of it. Then what?
With us, there's no recourse, there's no refactoring fees, so it's our problem. It's not the body shop.
Okay, so you never go back to the repair and say, we couldn't get that money, we need our money back.
I think the only caveat on that is if there was out and out fraud and the repair was involved in it, then we would. But no, ordinarily what happens is the body shop send us the payment back, we fund it, they close their file, because when we fund it, we're actually buying it off them, so it's our problem.
I got you. Yeah. Okay. Right, Pete, brilliant. Thanks for that overview. We're going to flip over now to a competitor of yours, Smart Business Link, Marie Hibbert. Are you there, Marie?
I'm here. Hello.
Hello, Marie. How you doing?
I'm all right.
Is it true you're getting married soon?
I am indeed.
Wow, amazing.
In about 2 weeks' time.
How exciting. So you're going to need some money for that.
Yes, please. I need a big bonus.
So welcome, Marie. You offer a sort of popular repair funding service as well, also a very big name in the market. I know that sometimes repair funding does work really, really well for repairers. I've heard them say it, and some people say they never want to go near it. In your experience, where does it work? What's the sweet spot? Where does it work really, really well for people? What are the kind of circumstances that makes them sort of go, yeah, this really does work for me?
I think for us, as a business, we're either industry experts or we're finance experts. So for myself being the commercial manager, I've been in the industry for about 20 years. So being able to understand the challenges that accident management companies go through, but also what the repairers go through, is a nice mix to be able to provide a good service. I think one of the most important things that I can foresee happening at the moment is the message about the best place for repairers to go look for the funding that they need right now for them to be able to get over the challenges they're facing. As Pete said, we've got the tightening of credit, you've got your CBOS loans to pay back, we've got HMRC that we've got to start thinking about early next year. The furlough scheme was fantastic. It helped a lot of the repairers to stay open and to sustain the business for a time. I'm not quite sure if they were able to put a plan in place for when that had finished. And at the minute, they've got the volume coming through finally, but they've got the issue around the parts. Yeah. So what do they do to be able to resolve this? I think going out there and looking at a finance option to suit the needs short term without actually understanding that contract and what they're getting themselves into. So because we understand, I'd like to say 99% of the work provider contracts that are out there that our repairers are currently working with, we're able to guide them around that. So we've got high volume, low margin on some of the contracts. So we don't just provide the finance solution for them and help to look at ways that we can help sustain the business, grow the business and help them to recover. But also it's understanding what work provider contracts they're actually signing and what they're getting themselves into. Everybody wants to take the volume on because they want to seem busy, but they don't want to be busy in the wrong way. It needs to be productive and to,
Absolutely.
So for us, it's understanding, yes, they need the work, yes, they need the money. We can help them with the finances, but also we've got a team of people here that understand all of the work provider contracts. So if any of our repairers contact us and say, we'd like to work with this work provider, we'll guide them around that contract straight away.
That's really interesting, because we're started a process of looking into all the different work contracts, and because the industry is in a quite odd situation. You know, as was previously mentioned, the industry has shrunk, definitely. Some body shops have exited, but a lot of other body shops just haven't grown back to the same size that they were pre-COVID. So we're probably somewhere around 85% of the size of supply available in the market.
Yeah.
And yet the claims have probably come back to about 90 or 90+% where they were. So we've got this odd situation where body shops have got lots of work at the moment, or most have lots of work. Some of them are backing up until booking in sort of January and stuff like that.
Yeah.
But also in the equally odd situation that they're not being offered more money to prioritise anybody's work, and many are considering sort of reducing some of the contracts that they work with. So are you actually saying also you're quite a good source for body shops to be able to talk to in terms of the contracts they should do less of and the ones they should do more of?
Yeah, of course, yeah. And I think as well, there's a grey area about the ban on assignment, isn't there? Which I think, you know, some of the repairers, they want to be able to work with a certain work provider, but within the contract, if it says you're not able to finance your invoices, they won't want to go for it. So it's sort of about, it's going a bit around about the way that it's forever turning around, because you know, it should be up for discussion really, when you take on that contract, that if it does say that, you know, you can have that open discussion. There's other reasons as to why, you know, there's a lot of reasons why people need to finance their invoices.
Yeah.
And I know that the ban on assignment is quite a big subject that I think needs to be discussed, and a lot of the repairers don't understand it. They just say, right, we can't finance these invoices, so we're not going to do it. And then they start actually struggling financially without realising they don't have to struggle financially.
It's absolutely true. I mean, you know, I remember years ago, insurance companies just flat out refused to allow their repairer networks to factor their invoices. And there's lots of reasons for that. And accident management companies also did the same sort of thing. And I think one of the reasons for that, quite frankly, is because the factoring companies got the invoices in such good condition that they weren't able to put them to back a queue again and reject them. But, you know, how has the market changed in that respect? I mean, should repairers be worried about damage providers if they were to factor their invoices or you know, sell the invoices?
I can only speak for SVL, obviously. So the way our approach is more efficient. So during the pandemic, we looked at all our processes in-house, and we streamlined them and made them more efficient so that we weren't a burden to any work provider, and we didn't hinder any relationship. So actually, we've sort of become really close to work providers. So it actually helps them. So working with the work providers has shown them the benefits of actually us handling all of their invoices and us being that one payment hub for them. So we've been able to show the efficiencies and tighten up on that. Yes, in regards to the rejections of the invoices, like I said, we've got a team of people here that understand exactly what that contract entails and how those invoices should be presented. So before they're presented, they're verified by ourselves, which in turn also does help the work provider with their contracts at their end as well. So overall, it works really well for us.
Yeah, it does makes sense. I'd never really thought about that before. So if I was an accident management company, rather than having hundreds of repairers phoning me on a daily basis about invoices that aren't paid and problems and this, an accident management company could, you know, hand over that whole responsibility to a company such as yourselves, and they can take away all that burden as well.
Of course, yeah. It works really, really well.
Yeah, it's interesting.
Proven successful, yeah.
Marie, that's been a really good sort of overview there. Thank you ever so much.
Is that right?
We'll probably come back with a few questions at the end. We'll see how we get on.
All right, thank you.
Can I introduce? Oh, Pete's got his hand up. He didn't like it. Hang about, Pete. What do you say, Pete?
Yeah, I just want to echo some of the stuff that Marie said, that there's misconceptions used to exist in the industry that if you, with body shops, if I seem to be fracturing my invoices, my work provider might think that I'm struggling and maybe about to fail, so they're likely to deselect me. I think that myth is pretty much gone, and what we do, I think it's just similar to Marie. When you get to a certain size, we have protocols with most of the work providers now, and as you said, they would rather deal with us rather than, you know, hundreds of body shops chasing them for payment, because it kind of works both ways, in so much as that our problem is to pay the body shop immediately, and our problem is also to wait then for the work provider to pay us when they say they're going to. So they'll have a contract with the body shop that will say we're going to pay in 30 days, we're going to pay in 60 days, whatever it is. And they know that with us, with the protocols we've got, that we'll just sit and wait. But the payment pack they will get from us will be absolutely perfect. So it's kind of win-win for them.
Yeah,
They've got less neither. They've got the payment packs in the correct shape. And then also we'll just sit and we'll wait. We're not going to start chasing them for payment. Whereas back in the day, you were right. You know, if someone would buy an invoice off someone, then they'd be all over that work provider to get paid. And they just became an absolute pain. So it has evolved from then. I think it's more mainstream now than it ever used to be.
Yeah, you're right. I mean, I think it did have a bit of a stigma attached to it. Yeah, just another little thought, actually. You know, so we all remember years and years ago when a really big accident management company went, or credit hire company went bust, and it left a lot of body shops with their fingers badly burnt. We're lucky that we haven't had that in, you know, many years, and I think the credit repair industry is doing okay at the moment. But if body shops are concerned about the stability of the people that they're working for, is it also a pretty good insurance policy to, you know, to sell the invoices?
Yeah, if you've got a pipeline of 30 days or 60 days, there's a lot of money tied up there, and therefore potentially a lot of risk, a lot of exposure. And that's one for the body shop to consider. But I think something Marie said as well, which is important, is that body shops are in a stronger position now than they ever used to be. So when it comes down to a contract that a work provider is going to give them, and we do this a lot with them as well, where, you know, they should stand up a little bit stronger and say, well, actually, I'm not quite happy with this clause or that clause within it. And because we're working with so many body shops, we can kind of advise and say, push on that. That's just a vanilla contract. If you push here and here, you'll find there'll be a little bit of give. Because ultimately, the work provider's got to get the balance. You know, they've got to get the best return they can for the work that goes into body shops. But if they don't successfully deploy the work and quickly, because they're measured on average repair costs and usually key times. So if they can't find a body shop because the terms are pretty onerous, then that creates a bigger problem for them. So it's, again, the message of the body shop is be strong, stand up, and if you're asking for stuff that's reasonable, then you get a reasonable hearing. You might not get what you want, but you know, if you don't ask, you don't get.
I hear what you're saying.
I think, can I just add something really quickly? I think what's also important is that any invoice that we finance and take under our control is all covered by our insurance policy. So we handle the insurance policy, we look after it, we make sure you've got the limits that you require for anybody to grow the business, because that's what we're here to do. The invoice that we finance is covered for 90% of the debt. So for the reinsurance of the repairers, especially now, because, you know, we're still early stages into recovery, we don't really know. So it doesn't matter whether it's a purchase off a ledger or if it's a couple of months old and we purchase it. Once it's under our control, it's always covered under our insurance policy. So for our repairers, that protection for them is always there, so they don't have to worry about that either.
Thank you, Ray. Thank you. Can I just introduce Ray to the call as well? Ray Jones from ZLX. Ray, you specialise in, welcome to the call, by the way.
Thank you.
You specialise in tax credits, don't you? I mean, I would have thought body shop accountants are used to sort of picking up every kind of, credit they can get. Yeah, is there hidden stuff out there that
I think
the average guy misses?
Yeah, it is hidden, and actually it's the title, research and development, because so many of us turn off and just think I'm not a scientist, I'm not an engineer, it doesn't fit me. And even if you go on to HMRC's website, the first sort of paragraph about who can claim puts you off. But it's not the case. We've made claims for over 40 different industries. Wow. 90% of those companies had no clue that they could make a claim. And now they're doing it every year. If you take away the words research and development and change that to sort of business progression and innovation within your business, problem solving, really, and certainly around COVID, that comes into it. Quite often that comes into it. If you're doing things that are unique to your business, that you've never done before in a certain way that's different. I mean, but it can be basic. It sounds difficult, but it's quite
a broad kind of term, really, research.
Very broad, yes, because you're improving your business. And you just think I'd have done that, to make it work better. But actually, that's research and development. In the way, I'm sure with Body Shops, we had a great call with one of your members that actually knew about R&D, and he was shocked about some of the areas that had been missing.
Really?
When we talked it through, there's so much going on within a body shop, and new materials, new glues, your supply chains, information around your customers, information around outside anybody you're dealing with, really.
So mechanically, right? How does it work? So let's say a body shop or a body shop group invested, let's say, £100,000 in some activity that could be classed as research and development during the course of the year. What would happen? What can you do for
them? Well, what would happen is they tell us the story. I don't need much time from a client, say 20, 30 minutes on a phone call. They'll explain. They probably won't know what it is, but we'll find what fits, and then we write a story around it, that why it was needed, why it's different, well, how it helps the business, what's going on in the future. We look back 2 years, and we can claim for 2 years, but it's all part of the business planning as well, which actually fits in with business sale in the long term as well, because it shows the credibility of the directors looking at every avenue. But we look at that, and then we write a story, and we add costs to that. Now, if it's manpower, if you've had a lot of staff time in there, that goes in, but you don't have to have logged that time. You can guesstimate in percentage-wise how much time they've spent on it. So then you put the salaries, you put outside costs, you put agency costs, all sorts of costs you collect into that project. And then between 20 to 30% of that 100 grand will come back as cash into your account within a month.
I mean, I know you've had some big wins in franchise dealer space, haven't you? Which isn't massively different to body shop world.
No.
I mean, what's the kind of magnitude of credits that you've been able to achieve? Are we talking tens of thousands or?
Not a major, a sizable but not major trader. We've bought back. Also what I call a dealership. Has got over 600 grand in this last year. We've done 3 claims for them.
Wow.
We've just done a football club of over $1 million, which you wouldn't think R&D in football clubs, sports clubs. There's so many different areas that do fit. Around COVID, some of it now as well, changes that have been made on that. But our average is £77,000 that people get back across the business. That may go down this year because people got less turnovers from the COVID year, but that's certainly what we've been getting them back.
So it's well worth a look, isn't it?
Oh, it is. I mean, the HMRC average is 45 grand, so we do a better job than the overall average. But even that's a sizable amount of money that you didn't know you had. It's sitting there in the pot, ready for you to take it. So
how would a body shop engage with you, Ray? So if a body shop that's listening or listening to recording thinks that they may have done something in that space that could sort of work as research and development. They're busy guys, they're running businesses, they're not tax experts. Who is the right person to talk to?
The business owner, senior directors are the best. because they know what's going on. Not always the FD, surprisingly, because their numbers are not always into the technical side of what might have been happening. But all useful. Anyone that understands the business is really, the higher up the better, because they own everything within the business. They understand, you know, and where it crosses over. But then literally they spend, you know, on a Zoom or a call with me, 20 minutes, and I can find out whether they've got something or not. And then if they're interested, then we go take it to the next level and start doing the work.
Right, I've been really,
unless we win. Yeah,
I'm really interested for people to sort of, you know, come forward and see what they've got. And I'd love to hear any sort of stories that you've got of body shops and what they've been able to claim for, and stuff like that. So I think it's going to be a pretty interesting journey.
Yeah, I mean, literally, coincidentally, just before this call, I got a body shop. A guy phoned me with a body shop. He said, I've got the guy in the car now, and because during COVID and that, they moved into engine mapping in the same premises and all that. I said, yeah, that absolutely fits. You know, if it's unique to what they do, then it fits. So there are changes that have happened as well. You know, health and safety, you know, the paint booths and all the rest of it. How do you deal with the chemicals? How do you manage that? Have you found a way to use less electricity, less power? All of that starts to fit as innovation. Rishi in his budget spent longer talking about R&D than anything else. It's major for the betterment of companies and what the UK wants to do. So it's great. I didn't believe in this, Chris.
So really the government are encouraging, you know, businesses to adapt and change and move forward, and they're giving them the incentive to do that in the form of tax credits. Yeah, absolutely.
I mean, my first claim that I did was for an events company, a friend of mine that, you know, I did this just before COVID, just started playing with it. But I didn't believe it until the first one came through. And she got 187 grand was her first claim. She's done 3 now. But again, an events company, you wouldn't think it. But you think how innovative events are.
Well worth
the attention of the person
a look then, Ray.
In the audience. So yeah, it's great fun.
That's right. I might well come back to you, but we got a couple more people to talk to. Steve, is Steve Bolt there?
Yeah, hi, Chris.
Hi, Steve. How are you?
Very good, thank you.
Good. Listen, Steve, we've just, you and I have just started looking at sort of big picture total membership spend, haven't we? You know, in terms of paint and parts and equipment and people and everything else, and it does come up to a pretty shocking number, doesn't it, across the industry? What sort of thing have you been able to do for, you know, other groups of businesses or, you know, associations like the NBRA? Because I think you've looked at some other sort of spaces and other industries, haven't you?
Yeah, I think one of the challenges that any industry has is that it's all got a footprint in terms of what it spends. So suppliers, by and large, like you to come to them individually, because if they come to individually, they can make better margin. If you come as a collective, you come as a group, you usually get a better deal. So one of the key challenges really is to actually get the collective buying power of the NBRA and point that at supply chain, because that will get the supply, that will just get you a better deal overall. So we've worked right across the scope of right through from just basic supplies, workwear, hygiene products, you name it, sort of that, and right through to the renewables, electric charging points, for example. Some great deals out there. We're taking on mass to certain suppliers. So there's and mobiles, IT, you name it, really. Anything that's an overhead and a spend, we can package for a supplier for the membership. So it really is right across a very, very wide spectrum of what we can do. I was really interested actually in what Ray and Chris were saying earlier as well, because what we try and do is what we call a profit improvement plan. You know, you're looking at the overheads of a business and corralling what a business does, and actually looking at driving through more profit. That helps when you're trying to sell. It also helps when you're trying to grow and you're using technology. So it actually works in both bits. And actually, we as a business, and we're just an office, I've actually gone through R&D tax credit in our office, and we've had some quite big rebates. So I understand the process. It's a really big thing that businesses are missing on. So I think looking at what you've got as a panel here, my role is to grab everybody on this call, package them for a client, so we can look at financing, we can look at R&D and overheads and drive profit into a business.
Yeah, I suppose from, you know, if you want to sort of improve a body shop business, you know, you can look at the terms that you're working with, but we all know how bloody difficult that is to get those changed. You know, you can look at your efficiency of operation, but you know, as we know, body shops are really running really efficiently already. They've been forced to become more and more and more efficient. But cost savings just are instant, aren't they? If you can find a cost saving in your business, it goes straight to the bottom line instantly. Where do you think the soft targets are for our industry? You know, having had a brief sort of look at it, do you think there's any soft targets that we should really be focusing on?
There are a couple, I think, that you can look at initially. I think there are some challenges as well outside this. I think the soft targets for me would be things like your supplies. So like looking at the day-to-day spend on your workwear, your hygiene products and so on, because they're fairly high margins built into that by suppliers. So those are ones that when you look at spend, a typical sort of member is spending, we did a bit of research before this. We think across the supply chain for a year could easily be £30,000 to £40,000 per site. Almost, it's quite a big spend. You could probably take 20–30% off that just by actually pointing it into a certain supply. That's sort of things you could do very easily.
What about energy, Steve? Because you know we've all heard that energy prices are going up 4–6-fold, and yet you know, and we're hearing about the energy companies going out of business, and yet you know the body shops aren't seeing much of that pain yet. You know, do you know why that is, and what's coming at us?
Yeah, one of the downsides of the energy market to a degree is that when you buy a contract, you're sort of locked out of the market, which is a good thing at the moment for a period of time. So if you buy a 3-year contract, you fix a rate for 3 years. And for 3 years, you don't see what's happening in the real world behind it.
Yeah.
As a simple example, so people would know here, one of my clients happens to be the local rugby club down here in the southwest where I'm based, which is a Premiership rugby club. And looking at their contract and the conversation I had with them this week, we're looking at almost doubling their contract this time next year when they come out. So the issue is the pain along the way for the membership will be, you have a certain rate today, you really do need to contact the people in this space and get an idea of what the pain will look like tomorrow when you come out of contract, because you're going to have to budget for that. That's the challenge.
Yeah.
So the big issue then is how do you then reduce your carbon footprint? Because if you actually start saving energy, then you don't actually end up spending that money in the future. And that's about a plan, having a plan in place to bring down usage on site. So something that Ray said actually was quite interesting for me is that I have kit, for example, that can be put on sites. Now that kit could be an R&D tax play for a business, because that comes at a cost which they can offset, because they're actually then trying to understand their business, what it's doing, how it's using something. It's basically a technology play. And that can then help a business think, well, actually, I'm using this. Why is this going on at X in the morning when I have to put it on later? Just little adjustments like that, you'll bring costs down. Just
straight away, just simple things you can do to take cost out of the business very quickly. Steve, that's super. I'll probably come back to you in a moment.
Okay.
And finally, Steve Johnson. Hello, Steve.
Hiya.
How you doing? Thanks for joining us. What sort of advice could you give a body shop business that is seeking corporate finance or even asset finance? Because oven can often be like £80,000 kind of investment. What sort of advice could you give to them? Oh, I think he's frozen. Is everybody else seeing that? Yeah.
Yeah, he's frozen.
Okay. Maybe, Steve, we'll come back to it. It's a way, isn't it, with technology? It always lets you down right at the most important moment, doesn't it?
Chris, there's I don't know how this thing works. I've noticed there's a couple of questions on the Q&A. One we covered, one we haven't. So I don't know. Should we?
Yeah. Okay. Well, let's sort of pop into those, and I might have a couple myself actually. So we've had one question sort of saying, is there a sliding scale for factoring invoices based on the amount of invoice that is bought and what the fees? So does it, do the fees alter according to the size of the invoice, or is it the size of the risk? And there's a bit of a perception they can be as high as 8%. Is there any truth in that, or is it a lot?
Not with us, and I doubt with SBL as well. The pricing, it tends to be around about the 3% mark. Yeah. And obviously, volume, we deal with casual users and we also have contracted ones. So as I mentioned, with the contracted ones, where we're bringing technology to bear to reduce all the frictional costs, improve efficiencies, and then there's volume with that, we can do a little bit. But yeah, 8% is just crazy. Anyone paying that should definitely pick up the phone.
It should stop urgently.
Yeah, stop, stop right now. As far as the work provider goes, we tend to just look at it that there's normal and then there's risky. And we kind of self-insure to protect against the riskier ones. So it's our problem. It's not theirs anymore. We touched on it before. So yeah, it's moved a lot from, I don't know where you got the 8% from, but
yeah, okay.
Yeah.
I don't think anybody would be doing it 8%.
Yeah, I think they'd be a bit bad to be doing that. They wouldn't have a business, would they?
I think they still go out of business.
I think for us at Smart Business Link, ours is always relative to the actual repairer and what their requirements are. We're here to drive the costs down to help the repairers to help sustain the network. So it is all relatively based upon their turnover. It's not based on the risk for us, because our risk is always covered by our insurance policy. So any fee that we agree with the repairer is a fixed fee. It doesn't ever change. We don't ever charge if any of the invoices go overdue, because again, like Pete said, that's our problem, not the repairer's problem. And then it all includes the bad debt insurance policy. So for us, the bad debt insurance policy is, I suppose, one of the key elements to this. If any of the repairers was to go and get their own insurance policy, it would cost a lot more. So
yeah, okay.
It's always built into our cost, but it's not nowhere near 8%, and it's also just based on turnover.
Without you sort of mentioning any names, obviously, are there any work providers that you refuse to work with as a business? You know, are there some that, you know, they're just too risky?
We go through quite a strict compliance process before we start working with any work provider. Yep. So, and we take advice from our insurance company as well, who will direct us, and they will write the limit according to what they think isn't a risk. And it could be at any time throughout the year if they feel like, because they watch them and they'll have the trigger points and the alerts. And if they need to alert us about something so that we're aware of something, they'll let us know immediately, and we're able to then speak to our repairers about that.
Yes, from our perspective, it's a pretty similar story, except that because we took the decision to self-insure a long time ago because we fully understand the industry. So whilst some work providers might appear risky to a third-party insurer having a look at them, we understand the market. We know how it works. We know all the moving parts. We can take a bit of a view on it. So we do due diligence, and unless there's some horror stories, then no. But ultimately, as long as there's a genuine repair, you know, then it's got to be paid. There's an insurer somewhere that's got to sit behind it.
Absolutely.
Yeah.
Okay. Well, thanks for that. Listen, I think we've lost Steve Johnson permanently. I don't know what happened there. You know, maybe he hadn't paid his Virgin bill. But listen, and I think we've covered most of the questions as well. I don't want to sort of take up too much of everyone's time. What we'll do is, I presume everybody will be happy for NBRA to share this webinar with our broader membership, because I think, you know, people haven't always got the time. They're really busy at the moment to join in and take an hour out, but they're more likely to do it when they've got a bit of time and zip through it. So we will share your contact details with that, if that's okay, and a brief description of what you do. We'll share the webinar, and, you know, for anyone that's listening either today or a bit later on, if you have any questions for NBRA or the panel, do pop them through to us, and we'll do our very best to get them answered. And if this has been successful, we'll probably do a follow-up finance surgery drop-in zone in a couple of months' time. So just to close off, a massive thank you to all of our panelists for joining us today. I'm really, really grateful. It's been a little quick journey through the world of finance, but you've provided lots of very interesting information there, and I'm sure we'll catch up with you all soon.
Fabulous. Thank you very much.
Thanks so much, everybody.
Thank you.
Enjoyable.
Take care all.
Thanks.
Thank
Bye-bye.
you.
Bye-bye. Bye-bye.